intent in itself is nothing very new. I think CoW is the first application that really took it to the next level of like providing then a user application that is providing the whole bottleneck of like having a competition of an execution layer rather than just having one simple on-chain execution model.
Welcome to a new episode of When Building. I'm your host, Stephanie. This is a highly anticipated episode for myself, as so far I have released 2 episodes in When Building. One is about DEX, the other is MEV. And when someone starts to dig into these 2 fields and see what's new, they will run into CoW, which pioneers in many trending innovations in this landscape as an MEV-aware dApp. And today, we are so honored to have Anna, CEO of CoW, to be our guest, to share the very original thinking in product design in CoW, which I believe is a very good example of order flow auction design. So without further ado, let's kick off today's interview. Hi, Anna. Can you tell us your Web3 story? Let us get to know about you and give a brief introduction of CoW. And I think we can leave the details to our later discussion.
Sounds great. Thank you so much for having me. So yeah, I'm a co-founder of CoW, and my background initially was I was a data analyst at the United Nations. Got, I guess, a little bit annoyed with all the bureaucracy that was going on and things just moving very slowly. So in 2017, I got more and more familiarized with blockchain. I was living in New York City at the time. So there were a few blockchain meetups that I started attending and then got really hooked and excited by blockchain and joined late 2017 Gnosis, which is one of the big OG projects that already started building on top of Ethereum before Ethereum was even live. And then worked in as part of Gnosis for a few years and started as part of Gnosis to also work on CoW. We had been looking into batch auctions for a few years already for multiple reasons. One, because we felt like batch auctions provide a more efficient way of providing liquidity on a highly fragmented DEX market. And then secondly, also as it is a solution to prevent MEV. And we launched in late April 2021, we launched CoW, and it started to get quite some adoption. So we decided, let's take it out of Gnosis and see where we can take it if we really have like a small team focused primarily on CoW and really pushing on all ends. And then beginning of 2022, we made a fundraising round. And since then we are independent. We're a team of 30 people now. And pushing the continuous development of CoW.
Okay, thank you for the introduction. I guess it is not your first time hearing people say that when they went to do a swap, they will intuitively go to Uniswap. And however, for more sophisticated users in DeFi, it is widely acknowledged that a better practice for retail trader would be to do the swap on a DEX aggregator, like 1inch or CoW. Of course, Uniswap now is part of the game. So before we enter a deeper discussion, I would like you to introduce the landscape of DEX aggregator to our audience and what differentiates CoW from other DEX aggregators.
I love to always use the metaphor of booking flights. So if you book a flight, for example, I think most people also use an aggregation layer, if it's Google Flights, Voodoo, Skyscanner, or whatever it is, to essentially check what airline offers the cheapest and fastest connection. And this is essentially the same kind of high-level mechanism for DEX aggregator. It offers the user to basically ensure that they find the best execution route for their trade on chain. Meaning that like the traditional DEXs, like the Uniswap that you mentioned, or SushiSwap or Balancer, are single liquidity pools where user, if they trade on that UI, they would directly be routed to the underlying liquidity pool. which works usually fine for smaller trades, but as soon as you want to execute a larger trade, you require really, really deep liquidity pools in order to guarantee that you get a good price. So what a DEX aggregator does for you is, for example, also to split up your trade and say, oh, the cheapest execution route for you is actually if you split your trade and 50% of your trade is executed via a Uniswap AMM, and then 25% via Balancer and another 25% via SushiSwap. And this is what DEX aggregators do. They additionally also have the ability to add private liquidity. So in the case of CoW, for example, there's also private market maker liquidity access. That means that sometimes you can even outperform existing on-chain prices. And then the difference between 1inch Uniswap and CoW is that CoW was really pioneering in the area of intent-based trading. I think we will dive into this a little bit later. But essentially, it allows the users to only express their wishes of, okay, this is the total amount I want to swap, and this is the limit price that I'm willing to accept. And then we engage in a competition there where multiple solvers, it's external, basically price finders, are competing and finding the best price for the users. And they're also aggregating actually 1inch and other aggregators such as Paraswap and 0x to double check whether they have any good routes to find good efficient execution. And then the best price or the best route is being selected and the transaction is executed for the user. And then there's some more specifics like that CoW has built in. So user trades can also be matched peer-to-peer against other users. And that has additional price benefits. And then lastly, there's also a protection layer to protect users against MEV attacks. So basically this maximum extractable value that can be exploited from user orders. And this is in a way how CoW differentiates. So 1inch Uniswap always started off as an AMM. 1inch started off as a DEX aggregator, and then CoW built this intent layer on top that makes it more sophisticated. Now 1inch and Uniswap have partially copied that model, but it's only it's an incomplete copy so far. So there's still some differentiating factors that are unique to CoW as the batching that I mentioned.
Okay, Anna already mentioned many innovations in CoW's design. And in order to have a full picture of this paradigm, I would like Anna to introduce the trading cycle in CoW and explain why design in this way and how is it different from the regular transaction we are used to. And then we can talk about each design decisions if I have further questions. Is that okay?
Yeah, that sounds super exciting. I think most users are used to basically signing a normal Ethereum transaction, where they commit already specifically to parameters in the transaction. And then what is unique to CoW is that it allows for signing a message. So this is essentially what intent-based execution is, like the big hype topic of this year, essentially. It allows users to sign a message that then enables a third-party execution layer to take those parameters and execute it for the user on-chain. So to talk about the transaction lifecycle, what happens, the user goes to CoW, they pick a sell token, a buy token, and a limit amount, and then also the expiration of if the order doesn't get executed in the next X minutes, I don't want it to execute at all. And submit this basically by signing a message in the user wallet. Then this transaction, this order gets collected in an order book, and so do all other orders that are coming into CoW protocol. And then all the existing orders that are in the order book are being accessed by our third-party competition participants that we call solvers. They are professional on-chain execution layers. Like they have really advanced mathematics to really calculate on what could be amazing execution routes that really optimize the execution path for a user order, and they compete with each other. So the next step is all of them, they collect the information that's in the order book, and then they try, based on the algorithm, to find the best possible execution path. And then they all submit a score to CoW protocol, which then ranks the executions based on which one is providing the best value add to the user. So which of the solution is the one that most maximizes the value that's given to the users. That is then the solution that's being picked as the winner of the auction, and that solver, who is the winner of the auction, gets then to execute the transaction for the user. And yeah, that's essentially the life cycle.
Okay, thank you. So let's imagine there is a graph of trading cycle in the air, and from left to right is intent expression, batch in order book, auction, software system, and the execution on chain. And I will poke further questions following this question. You just mentioned the benefits of the signed message of intent instead of transaction. But my question is, in the implementation level, what does this signed message mean to the users and the selected solvers? Does it involve any trust assumption that may put users in a risky position?
No, that's essentially the beauty of the system. Is you as a user, you still set parameters that are by smart contract design, the ones that need to be stick to. Like they cannot be, like you cannot, if the user says, this is my limit price, the limit price by smart contract design needs to be respected. There's no way of exploiting it. The different parameters that I said are the sell and the buy token, and then the limit price. So the limit price automatically also ensures that you have a slippage tolerance. Theoretically, the user can say, I want to have 0 slippage tolerance, but then you have the risk that your transaction doesn't get executed, right? This is like the same, whether it's a signed message or a transaction that you submit via Uniswap, you have the same issue. The difference is that if you submit this via Uniswap, then you have no guarantee that your slippage price is not exploited, right? This is like where MEV arises as a concern that the user places a normal order that's not protected on a normal transaction execution application, such as Uniswap, defines a large slippage, and then that gets exploited. On CoW, you have more guarantees in the sense that you have a competition that even if one solver were to try to exploit your slippage by under-reporting on what is the best execution route found, you have the strong competition of 16 different solvers, where it's very likely that at least one solver is essentially providing an honest execution route. And since you have that competition that guarantees that whoever provides the best execution route for the user is winning, it makes it very tough for a solver to actually exploit that slippage tolerance. But you have the guarantee that all parameters you're setting in your message are implemented and executed on.
Okay. In the episode with Radar Bear from Dodo, he mentioned that actually intent-centric or intent-based model is nothing new. The reason why the whole model prevails since DeFi summer was that it is suitable for launching long-tail tokens. So my question is, what makes intent-based trading getting popular these days? And is the order book used in CoW a simple revival of central limit order book?
Yeah, that's also a good question. So I think first of all, I would almost agree that like intent in itself is nothing very new. Like intent, like as in submitting on-chain messages, has existed before. I think CoW is the first application that really took it to the next level of like providing like a user application that is providing the whole bottleneck of like having a competition of an execution layer rather than just having one simple on-chain execution model. But I think the hype is really, I think it's actually a little overhyped, to be honest. I think this year almost every project started to jump on the topic and try to make something out of intents, and not all applications are equally useful. But I think there's also good reason for why intents are becoming so popular, and it is because it is a huge user experience improvement. Think about all the things that you as a user have to consider if you want to place a normal on-chain trade. It starts with with more simple things, maybe, as you need to define your slippage. But even there, it's like really depends what is the good slippage for a user, depends on what token are you trading. Is it like a highly liquid token or less liquid token? Is it very volatile currently or not? How large is your trade size? Is it a small trade size or large trade size? And depending on all those factors, you should ideally pick a different slippage tolerance. And this already requires like quite some advanced knowledge. Then you have other issues when you submit a transaction. It's now with like MEV, this multi-billion-dollar business that is extracting value for normal innocent users who are not professionalized in submitting transactions on chain, that expose huge risk on losing funds on chain. And you cannot expect every user to even know what MEV is, right? Like, we want to get more adoption of blockchain, and we won't get more adoption if we expect from every new user to understand what MEV is, what is the risk, and how they can circumvent it. And with the innovation of intents, you essentially allow users to simply express what they want to do, and then have a more professionalized party to execute on behalf of them. And I think this UX improvement is really needed to get the next wave of adoption.
Okay, and you mentioned that to protect the users, so you introduced a competition of these powerful players. And my question is, how does CoW nurture this competition? I'm not sure if nurture is a right word. And how do you evaluate whether the competition going on is fair or not? As sometimes the lack of competition will happen, and we will have some dominating players in the game, right?
Yeah, I think this is a super relevant question, because if you don't have competition, you don't have the guarantee anymore that users actually get good execution. Initially, how we bootstrapped was that we as a team, we were still part of Gnosis. We built a few solvers ourselves. And it's actually not that complicated if you want to participate with a simple solver. You could, for example, collect the API endpoint of a few aggregators, such as Paraswap, 1inch, and 0x, and then always basically compare the values that they return, and then decide to submit the trade to whichever API is providing the best return for a trade. This would be like a simple implementation of a solver that is like not very advanced, so not very competitive, but it's like an initial start to try to get into the solver game. And so when we were at Gnosis, we like bootstrapped some of those initial solvers just to bootstrap the competition. When we spun out, Gnosis decided to keep operating the solvers. So now Gnosis is running a few of the solvers that are also ensuring that always like baseline prices are being met. And then the next step we did was we were participating in the in the Dev Connect Amsterdam hackathon that took place a year and a half ago. And somehow, I guess we almost got lucky. There were a few people there who we met who were like highly intelligent, very mathematical, and started to get really hooked by the idea of operating in solver, and like started to work on their own algorithms. And they're fairly small teams still, but they're just very focused on the problem and have managed to really outcompete like APIs of, for example, 1inch, who has, I don't know, 150 people team and been working on this for years, but like really by having like a small team of external players who are competing on finding the best algorithm turned out to be very effective in bootstrapping better execution routes. And the next evolvement then was essentially that market makers also started to get interested by this and started to integrate with existing solvers by providing their own liquidity. Because of course, sometimes market makers are able on specific token pairs to outcompete existing on-chain prices. So for a solver to, in certain situations, have access to private liquidity can also put them in a better position and help them to win the solver competition. That was kind of the next step of the evolution. And right now we have, I think, 16 different solvers that are part of the competition. And the beauty is that also each of them are specializing in different things. So we have a few that are specializing on really batching transactions, so finding possible ring trades, finding possible matches across the existing orders that are in the same order book. So essentially matching really multiple user orders peer-to-peer, which has additional price benefits. Then there's other solvers that are specializing on adding always the newest liquidity pools. And then there's other solvers who also specialize on really finding more elaborate execution routes that is also evolving, like repositioning of portfolio projects, etc. So there's quite a variety. And I think, yeah, what's ultimately important is that you maintain this competition in order to guarantee best prices are found for users. And how we bootstrap this currently is that we pay out a solver reward on a weekly basis. And the reward is given based on two functionalities. One is that there is continuity, because you also want to ensure that solvers that are continuously participating in the price competition, and not only when they think they have a strategic advantage. This is needed to ensure that they're not only quoting by the time that they think they will win the competition anyways, but you want them to continuously quote in case of some of the solvers going offline or becoming malicious or whatever. And the other part of the prize fund of the rewards is given based on how much the solution they're providing is better than the second best. So that is to ensure that they're not focusing on finding like a solution that's 1 cent better, but that they're actually focusing on finding significantly better user routes, because based on how much better their solution is compared to the second best solution, the higher their reward is that they will get.
Okay. I guess you just mentioned that CoW would cover part of the incentive to the solvers, right?
Yes, correct. Basically, it's a weekly payout of CoW tokens to the solvers.
Yeah. Some people may question, is this sustainable, or is this your long-term strategy to provide these incentives?
It's definitely at the moment providing us with a competitive edge. I've spoken to a few solvers such as Propeller Heads and Enso, who are performing extremely well. They're amongst the best performing solvers. And they are, for example, currently not participating in the 1inch competition because there the incentives are not well aligned with solvers and it's not profitable for them to be there. So for us, providing rewards is really an initial step that is required to onboard relevant competition for the users. The emissions we are paying for this is up to 2% of the total CoW token supply per year, which I think is in itself, it's sustainable. However, we are also looking, of course, into like ways of over the long term to reduce those emissions. And what we will introduce in January is a small fee but the fee is only taken from users, but only on the value add we provide. So if we are providing users a better solution than any other platform could, this is from that value add we provide, we would take a small cut. And this cut is collected by solvers, but they have to use that to buy back CoW tokens and send it back to the CoW treasury. So the idea is that over the long term, the emissions that are being paid for solvers are covered by the fees that are taken from the protocol, and then it becomes very self-sustainable.
Okay, thank you. Can I say that the solver set in CoWSwap is permission?
That's an interesting question. So I would say theoretically it's not. In practice, there's still some permission components. The reason is that, as I mentioned before, there is the possibility for a solver to theoretically exploit the slippage tolerance of a user. This is, again, highly unlikely because you also have the competition of different solvers and so on. However, it's a possibility. So because of that, we require solvers who are participating in the competition to set up a bond. This is basically, it's a pre-requirement to participate in a competition. It is not necessarily centralized. It still has some centralized components at the moment because CoWDAO itself is also curating a bonding pool to reduce the entry barrier. But what we will be working on next year is that solvers really start building up their own bonding pools, and that there's an automatic check by a smart contract that checks does solver private key also provide access or has established a bonding pool as well. If so, solver is automatically added to the competition. So there's one slight permission component still of basically solvers have to reach out to us personally to be add me to the bonding pool, I want to participate. So far, this hasn't led to any solver not participating, but it's something that we will automatize next year.
Okay, very interesting. And my last question is about the surplus or the rebate given to the user as will it affect the possibility for the batch to be included on chain? As under the architecture of PBS, the block with the highest value can win. And does this rebate or surplus cut from this bit?
So what happens is that the surplus is collected essentially before it touches the PBS layer. So the user order gets submitted. It's competed for finding the best surplus for the user orders, and then the solver who has the most surplus maximizing solution wins the competition, and then is the one who executes on chain. The benefit is that also how solvers currently execute is they are using MEV blocker. It's another product that CoWSwap is working on. And that allows them to additionally fully protect the user transactions, again, front running and sandwiching. But yeah, essentially it's not competing on that in that sense with PBS. It has no impact on the inclusion time of the transactions in a block.
Okay, I guess this is the last question about this part of product design, which is where do the solvers or the winning solvers send the winning batch to? Because some data scientists said that the communication between OFAs and the builders are quite opaque. So I'm curious, what are the strategies of CoWSwap?
Sorry, can you repeat that? I didn't fully understand the question.
Okay, my question is, where do the solvers send the winning batch to? Because I hear some scientists share that the communication between the OFAs and the builders are quite opaque. So I wonder the strategies of CoWSwap.
Wonderful. Yeah. So solvers that are participating on this CoW competition, they currently all submit their transactions via MEV blocker. So what they do is usually do a pre-check. Is this transaction prompt to be front-run or sandwiched, or even might include a back-running opportunity? If so, they submit it via MEV blocker. MEV blocker is this private RPC endpoint that we're working on that guarantees that your transaction can't be front-run and sandwiched. It submits it to a permissionless searcher system where searchers compete on finding the best backrunning opportunity. As backrunning can really be argued as like not a negative MEV, it's like an MEV attack that cannot be avoided in a sense. And then 90% of this backrun is being returned to where the transaction is coming from, so essentially the solver. And then the remaining 10% are being used to basically ensure a fast execution time into the next block by splitting the reward between the searcher, block builder, and validator. So this happens for transactions that might have some additional risk of MEV, and then transactions that are already seem like they have no MEV externalities, they are normally submitted via the public mempool.
Okay, thank you, Anna, for bearing with me for this bunch of small questions. I hope you will find the following questions more interesting. After launching for 2 years, can you share some metrics that indicating the effectiveness of batch auction model, or do you find any drawbacks when it comes to fulfilling the functions of a DEX?
So I would say from the user perspective, it's clear that there's only benefits from implementing a batch auction model. You have the price benefits by essentially allowing to match one user order with multiple other user orders. You can ensure gas price benefits, right? Like by matching them directly rather than doing complicated on-chain execution, you reduce the needed gas that's required. You also, you then in cases of peer-to-peer matching, don't have to pay protocol fees. So usually, even if we route via Uniswap still has a protocol fee of, I think, was 0.03% for liquidity providers. So this is avoided. And then lastly, also, you usually have a lower price impact. So there's really, for the user experience, being batched has significant price benefits. Then additionally, a benefit of batch auctions is the MEV protection, because if, and I think this is something you have covered in a previous podcast already, how does MEV actually arise? It's one of the big issues is you have usually for one single asset, multiple different price points on a single Ethereum block. So even on very liquid pairs as USDC, Ether, you can have 10 different prices on a single block. And that allows then third parties to take advantage of it and like shift different transactions around in a way that they can exploit as much value as possible. But if you batch transactions together and you have a unique single clearing price, which is part of the batch auction model, is that all assets in a single batch have the same single clearing price, meaning there will only be one price point across all users who trade ETH USDC in a single block. And by allowing for this, by implementing this, you avoid MEV. So you remove the possibility of inserting transactions to like change and shift prices around. And that's a secondary, very, very impactful effect of batch auctions. I don't have the current statistic on top of my mind, but it's last year alone, up to $1 million or so was like saved in user funds and returned to users via applying batch auctions. And of course, this is increasingly relevant, like the more user orders you actually have, the higher the benefit payout of this, because you have suddenly, of course, it's a difference if you have 3 transactions in a batch or if you have 20. If you have 20, you already have significantly more possibilities of matching transactions one with another. To look also at the drawbacks, I think the drawbacks are primarily on the execution side and the practicability. So it is making, like, allowing for batch auctions is making systems more complex. Like for a solver to come up with an algorithm that checks all existing transactions and is able to match them against each other is a complicated mathematical task. It seems easy in a case of you have user A who wants to sell DAI for ETH, and then you have user B who wants to sell ETH for DAI, so you can directly match them with each other. But batching can be increasingly inherently more complicated, because we also work with multi-dimensional order books. So if you suddenly have 100 different transactions and user A has something that user D wants, user C something that user Z wants, and so on. But ultimately, you can all match them together. That's a very complex mathematical problem, and requires a lot of capacity to develop such an algorithm. So I would say can also slow development down a bit, but from the user perspective, it only has advantages.
Okay, then do you see any particular type of trade that favors this paradigm in DeFi? As I saw some finding reveals that like bigger size trade will tend to use solovers model led by CoW, and medium-sized trade favors DEX Aggregator. Does this echo your observation? And what target use case did CoW have in mind?
Yeah, I think batching benefits all types of users, because even if you only want to exchange $10 and someone else wants to exchange $10, you're still significantly better off when you trade it peer-to-peer. The benefit that you get might only be $1, but it's still 10% of your total trade amount. So I think that can still be beneficial. But if you look in the comparison of when to use a DEX aggregator or an AMM, in general, DEX aggregators are more interesting to larger user orders, because Uniswap has fairly good liquidity, meaning that if you only want to exchange $100 or $500, most likely the liquidity pool on Uniswap are sufficiently deep enough to provide you a good price. But if you suddenly want to start to trade a few thousands of dollars, you might not get the best execution price anymore if you just go to one avenue, to one liquidity source, and then it becomes significantly better for you to split up your trade. And this is where aggregators come into place.
Okay. Now let's have a spicy topic, the comparison with Uniswap X. I clearly remember when Uniswap X was announced, quite a few spotlights were given to CoW because they adopted a similar architecture. And Anna just introduced some of the differences between CoW and Uniswap X. And I have this one question. I also asked Raider Bear from Dodo that to what extent did he think the dominance of Uniswap attributes to its first mover advantage and network effects? And his answer was an extremely high proportion. So do you agree with him?
His point was that what is a very high proportion?
He means that the first mover advantage and network effect of Uniswap contribute greatly to its success and its dominance.
Yes, I would highly agree with that statement, that this first mover advantage definitely helps significantly with the Uniswap adoption. I think it has significant stickiness. If you join the space now as a new joiner, it's like most of the Medium posts, the articles that you can find, they would all reference Uniswap because it was the first widely adopted or easy to use the AMM on Ethereum. It was the first AMM. And in such way, it is really a brand that has been around since, I think, when did they launch? I think 2018. And yeah, this as a news joiner, you already have like all these worrinesses of like suddenly you hold custody over your own funds, you make one mistake and you can easily lose all your funds by like accidentally filling in the wrong address. And then there's so many news about smart contract hacks or bugs that sound very scary. So of course, as a user, you want to go to a protocol that has established itself over time, and that a lot of like the people that you know, because they're influencers, because they are giving podcasts, they have been around, the OGs of the space, that they are approving of, because that gives us like the stamp of approval. This is like a product that's working. So I want to use something as a new user. I want to use something that I trust. And Uniswap definitely has this trust. It has been around for many years without any major bugs or issues. And so it's understandable that many users want to go there first. The question of how CoWSwap and Uniswap X differentiate is also interesting. I'm not an expert on Uniswap X, but essentially, yeah, CoWSwap pioneered this intent-based trading layer. We launched in April 2021. Then I think in January or so of this year, 1inch launched with 1inch Fusion, which kind of was like the first copy of the intent-based model that CoWSwap is doing. And then this summer during ECC, Uniswap announced something similar, what they call now Uniswap X. Yeah, I'm not an expert on their model, but as far as I understand it, what they implement is this Dutch auction design, which basically means that they auction off individual user transactions. A Dutch auction is a reversed auction. It basically starts at a high price, like what is the highest price that can be returned to a user, and then goes down over time. And the different solvers, in the case of the Uniswap model, it's actually, they're called fillers. They participate in this Dutch auction, and basically as soon as they think the price point is hit that they are able to execute on, they submit their bet. And the one who's fastest, who basically finds the most promising execution route for the user, is being picked, and then I believe has 2 blocks time to execute this order on chain. And if for some reason they fail because the price is not available anymore, for example, then the auction begins again, and then another filler potentially gets the chance to execute this. So this is different from the CoWSwap model, because the CoWSwap model has this different, we don't use a Dutch auction, but instead we basically have a fixed execution time, and then a fixed auction time, and then ask all solvers to submit their objective criteria, basically a score of how much value add they can provide to users, and then the winning one gets to execute the transaction. The benefit, I would say, of our model is that it allows for batching. Why is this not possible in the Dutch auction model is because they auction off user orders individually. And so as a solver, I can participate in multiple user order auctions, but the likelihood that I win in parallel is very low. Also, like the auction time always begins when the user submits the order. So if the user A submits it now and user B 2 seconds later, then the auctions are not synchronized. So I'm not even able to pass price benefits that I would gain from batching those 2 orders forward to the user. And in the CoW model, it's essentially the auction that we do is based on all orders that are in the order book. And yeah, this is, I would say, the biggest difference that I see between the 2 models.
Okay, that's quite interesting. I guess actually every Web3 users or Ethereum users should go to CoWSwap and Uniswap X to experience this 2 type of trading model. And now let's move our subject to MEV in a bigger picture. When it comes to MEV mitigation, there have been two schools of approach: minimizing MEV versus maximizing or democratizing MEV. Correct me if I'm wrong. It seems CoW adopts both, like by using batch execution and uniform clearing price, some MEV is reduced, while by using the auction game amongst solvers, the obtainable MEV is maximized and then redistributed. So do you think this approach can coexist, or do they contradict with one another in some sense? And maybe you could start with explaining this two approach and then tell us your opinion.
Yeah, I would actually correct you a little bit in this case.
Okay.
CoW is really the application CoW is really focused on minimizing MEV purely.
Okay.
And that's also the philosophy that we're driving, because I think there are some risks on maximizing MEV. So essentially, one is that once you start maximizing it, you are also that means you're extracting it from the user in the first place. And to extract the value, you need multiple parties involved, and then you need to reward them for their efforts, meaning that you have, like, the user won't get back 100% of their MEV because there's different players now involved that try to maximize the MEV from you. And then in the best case scenario, you get maybe a small refund. But our perspective from CoW is always the user is the one who creates the MEV opportunity in the first place. So why should they lose any of the value? And the second issue that I see with maximization is, since you need to redistribute the value, you also are less efficient. You require more block space, because now suddenly you need to include transactions of refund to the user, pay X amount to validator X, etc. And that creates basically, that makes the blocks also more full, so it's less efficient. And then lastly, if it's like this whole topic is also of maximizing MEV and the proponents of it, it ultimately led also to this huge complexity of now requiring PBS, right? Because there was like this worriness of, oh, MEV, like Flashbots initially brought MEV really at the forefront of the discussion, which I think in itself was beneficial. They were also in favor more of like democratizing MEV, in the sense that now everybody was able to access MEV and extract it. I guess to some extent it was good to like ensure that there's not single party players who like largely benefit from this. But on the downside, I think it also brought a lot more players into the game and really professionalized the extraction of MEV and made it maybe even a bigger issue than it would have been. I mean, we don't know. We don't know what would have happened without the discussion. But it's definitely a big issue today. And then when we launched Proof of Stake, it was very clear early on that if we don't provide a different infrastructure, then the parties that would largely benefit from MEV are individual validators, and that puts the whole ecosystem at a huge risk, because if suddenly you have 1% of Ethereum validators that are all significantly better in extracting MEV than all the other validators, then they make more and more ease over time, hence they have more ease to stake and run more and more validators, and they would slowly over time win a larger stake of the network. And that would put the whole decentralization of Ethereum at risk. And this is essentially what then was decided, okay, let's incorporate a system that allows to split the role of a validator and the block builder, because that allows us to ensure that that the benefits of MEV are not only reaped by a handful of validators. And so essentially the whole PBS, proposer builder separation, was created, which is of course a huge change to how Ethereum works in itself. And sorry, this is a bit of a long excursus for why I'm not the biggest fan of maximizing MEV. And from the CoW level, sorry about that. And so from CoW, we take the very opposite approach. We think the reason that most of MEV is even surfaced is really coming from user transactions, hence from the application layer, and hence should also be avoided at application layer. And this is what CoW is focusing on with the batching of transactions. So essentially by providing a unified single clearing price per each individual asset per batch per block. We ensure that there is not this possibility of sniping in transaction and reshuffling transactions in order to execute to extract value from a user order. And this is really what we are really highly advocating, and also hope to see more and more applications to seek adoption of models that reduce the surface of MEV.
Okay. The next topic I want to discuss with you is the idea of mitigating MEV at application level. It is an item in Vitalik's Ethereum roadmap, which is not part of the protocol upgrade. It seems this idea is quite controversial, and it seems to me that CoW is a pioneer in this aspect, and we can see more and more MEV-aware application coming out. But some people think that mitigating MEV should not be a big focus of that design, because it is the protocol that should be doing this job, as most MEV come from the 12-second block time on Ethereum. And what adapt can do is quite limited. So do you agree with this statement? And to what extent do you think mitigating MEV at an application level is limited?
Yeah, I would not agree fully with that statement. So where I do think is some sense to it is that, yes, some MEV or like significant amount of MEV is the top of block from cross-chain arbitrage, from DEX arbitrage especially, and that it's more difficult to solve. However, there's also other significant MEV extraction at place. And I think if you as a user, you place a trade on Uniswap and you lose 5 ETH, and that happens on like a daily basis actually, then I think you would agree it is still an issue. Maybe it's not 100% of MEV, but it's still a substantial amount of MEV that can be reduced. And it's possible to do this at application layer. And so me as an end user, I would demand, or I would actually prefer to use an application that protects me against this losing 5 ETH than an application that says, oh, I don't care, that's up to the protocol to fix this. And the answer here is also somewhat like is related to my previous answer. It's again some of the issues that arise if you as an application don't care about it is you basically shift it to the protocol. Then you have the whole issue again of it's being less efficient because you need to suddenly redistribute the value because someone is going to extract the MEV. And now you have PBS, so it's probably extracted by a searcher who needs to give part of the profit to the block builder, who needs to give part of the profit to a validator. And that creates a lot of additional transactions that are all filling up a block. So it's also less efficient. From the application layer design, it's where the user places their transactions. So this is inherently, those are the transactions that ultimately expose MEV opportunities. So by designing the initial transactions that are placed in a way that is reducing the MEV surface factor has a huge impact on how much MEV is ultimately exposed to an Ethereum block or any other blockchain's block.
Okay, I really like this answer. And originally, I have prepared the question for your opinion on PBS, and I'm so happy that you just expressed your PBS, your opinion on PBS previously. And so my follow-up question is, does the understanding of PBS affect the design of CoW?
Not really. I mean, it has an impact on the execution of transactions ultimately because most or all solvers actually at the moment are submitting via MEV blocker. And MEV blocker, this RPC endpoint, is accessing PBS as it's forwarding transactions to searchers who are looking for backrunning opportunities. Because again, backrunning is an MEV that cannot be avoided because it happens after a transaction was placed, like essentially leveraging price differences between different AMMs after the fact of a transaction. And this is something where basically at the transaction execution level, we are tapping into an RPC endpoint that is leveraging PBS, the searcher builder, basically a system where searchers find the best backrunning opportunity, give it a kickback again of 90% to the user, and use 10% for their own reward and the reward of the block builder. But other than that, CoW itself is not touching PBS.
Okay, then does CoW have a vision about MEV mitigation that could be shared with us? Of course, we know that you have already made the effort on the application level. Then about the protocol level or the whole MEV mitigation picture, do you have any vision that can share with us?
Yeah, so we really hope that MEV will be less of an issue in the future. And we think the way forward is that also applications take this issue seriously and start improving on it. As CoW, basically the DAO behind CoW, as I mentioned previously, we also worked on this MEV blocker product. MEV blocker is a more holistic solution. CoW is the best solution, I would say, on the market, honestly, to prevent MEV when you do DEX trading. But of course, there's other transactions that also expose MEV that are not related to DEX trading. For example, if you want to trade either NFTs or if there has been an Oracle update, and there's a bunch of different scenarios in which MEV can occur. And for that, CoW is not able to provide a solution, at least not yet. And so we built a separate product that is very easy to use for anyone, for any type of transaction, to ensure that they can protect themselves against front running and sandwiching. So this is this MEV blocker RPC endpoint that users can enable if they go to their wallet. Usually you can change the RPC endpoint. Most of the times the default is set to Infura or Alchemy or like similar. And then users can add this private endpoint MEV blocker that ensures that the transactions are submitted privately, so to avoid front running or sandwiching. And again, they can choose between two different endpoints, either full privacy that really ensures they're fully protected, like, I mean, in both cases they're fully protected, but that they have full privacy, that nobody sees the transaction beforehand, or they allow for the default option that allows back running, so they can even make some money in case that there's a back running opportunity on chain.
Okay, then here comes to our final question. Considering the things we have talked about, CoW has some plans in 2024, and I read that CoW also do research on AMM DEX design, and CoW is not supporting any layer 2 network yet. So what is the roadmap of CoW or the CoW protocol, and what can we expect in the near future?
Oh, that's a very interesting question. It's something I'm currently working on. So there's a few different initiatives. One is, maybe doesn't sound exciting, but we get a lot of user feedback on this, is execution speed. As a DEX aggregator, sometimes execution time can be a little slower than on an AMM, for example. Usually it shouldn't be significantly longer. In some situations it is longer, and so basically execution speed is like one side component we want to tackle, so that users in the future coming back to CoW are very quickly receiving the happy moo sound when they submit a transaction. And that's a side point only. We also want to improve limit orders. I think there were also some user feedback requests of like extend the time period during which limit orders can last, and a few other smaller things that we want to improve. Bigger items are layer 2s, what you mentioned. It's something that we have been long requested and long talking about. We want to deploy there also because, of course, it's relevant for some of our partners to have CoW there. So that's something we want to tackle in Q2 next year. And then there's also a few other exciting things we're working on. So we launched our programmatic order framework around October, November this year. And it allows for a variety of very highly sophisticated trading strategies. So simple use cases are time-weighted average price orders or DCA, dollar cost average orders, but there's also way more advanced possibilities. For example, you hold a maker, a CDP, and you want to make sure that your collateral is stable, meaning that if for whatever reason the value of your collateral declines and your position is at risk, you automatically check on chain a price oracle for this, and in case your collateral is at risk, you automatically buy more to increase your collateral and make sure that your loan is secured. And there's a bunch of variety of cool use cases that can be built on top. So we plan on expanding on those. And then lastly, we were also working on CoW hooks. This is essentially a pre and post order interaction, which allows to now have atomicity if you want to have a bunch of transactions in a single block guaranteed. You can do this with the help of CoW hooks. So for example, if you want to do lend X token from Aave, then swap it into another token and then swap it, bridge it over to another network like Polygon, for example, you can do this all in the single transaction on CowSwap. That's something that's technically already available and feasible, but we want to work on a couple of integrations that then make it easy for users to actually use it.
Okay, I really look forward to this improvement. Thank you so much, Anna. It is quite a loaded episode. Hopefully, audience of this episode would be more aware of the problem of MEV and start to change their trading behavior to protect themselves. And I'm sure there are still many interesting stuff we can dig in. I look forward to another episode with Anna in the future. Audience can find the CowSwap related information and Anna's Twitter in our show notes. Bye-bye.
Thank you so much. Bye-bye.